What's up, guys? Welcome back to my channel.
Earn it, save it, invest it.
In this video, I'm going to quickly break down the top mistakes to avoid when you're investing in the stock market. These mistakes could cost you thousands up to millions of dollars depending on how much you're actually investing. But these are mistakes that you really want to avoid, and let's go through them really quick. I got 10 mistakes and one extra credit mistake. So let's go through them really quick. From my own experience through the stock market and also doing the research and all of that, I also did ask ChatGPT what are the biggest and most common mistakes investors make in the stock market. And this is what it told me. Number one is timing the market. Trying to predict short-term highs and lows almost always fails. Even professionals rarely time the market successfully, and this is 100% true. You do not want to try to time the market, you want to have time in the market. And if we check out this article right here, this is on Charles Schwab, and it says, we ran the numbers on market timing. Our findings, that's a high cost to waiting for the best entry point. Now they go through this this whole analysis, right? This situation where they have investing styles, right? We have someone, Peter Perfect, who was the perfect market timer, right? He had the incredible skill. He picked the stocks at the very low when they could, at the very lowest of a specific year, right? For 20 years, from each person got $2,000 for 20 years, and it ended in 2022, right? So it started in 2002, ended in 2022, or it started in 2003. But they had $2,000 each, right? Peter Perfect, he had $2,000, and in that year, he bought at the lowest point of each year, right? Ashley Action, she was just simple and consistent. Each year she received her money and she invested the $2,000 on the first trading day of the year. Matthew Monthly, he took his annual $2,000 and he divided it into 12 equal portions, and he did it in each and every month, dollar cost averaging. Right, we have a couple of these other ones, and the results are in. The people who were perfect timing obviously had the best, correct? But when you look at invested immediately, right, this person is the person who just invests right away. You don't want to try to say, oh, I'm going to try to, no, just if you find a good business with good numbers and they have good growth and they have a good future ahead of them, you can just invest now. If it dips back down, then invest again when you have them. It's gonna just keep investing. And the longer you wait, the more money you're gonna leave on the table for someone else, right? Even the bad timing, right? The bad timing, you look at that, I forgot who it was in this, Rosie Rotten, the poor timing, right? They picked the word, what was it? Invested at 2,000 each year, the market's peak, right? So they always pick the very top of the market, right? When it picked, the peak, and then it dips back at whatever the top of the market was for that year, they bought then. And it's okay because it all came back, right? Now they didn't make as much, but they still made. So over 20 years, you can tell you just want to be investing. You can be investing at the wrong time. You don't have to time it out. You just want time in the market. Number two, emotional investing. Panic selling during downturns or chasing hype during rallies leads to buying high and selling low. The opposite of what you want. I always tell my children, buy low, sell high. Now, obviously, if you're thinking about certain things, you're not exactly trying to, that'd be, trying to time the market, right? But I also talk to them more about like real estate, right? Hey, if you go on the block and you see all these nice houses and you see a house that's kind of in the dumps and this and that could use a little bit of work, it's probably the worst house on the block. That's the house you want because you fix it up and now its value has gone up, right? But with stocks, you don't really want to try to time it out, right? You want to have it, you just want to buy when you can and then just let it ride. But a lot of people get emotional, right? They have a lot of fear and a lot of greed. If you check out the AAII Investor Sentiment Survey, it'll show you what happens with sentiment, how investors are feeling in the market. Right now, people are still feeling bearish. As you can see, it still says we are more on the bearish side than on the bullish side. But if you look back a few weeks ago, this was at historical lows. It was historical lows. And, all of those times, this was just a few weeks ago, right? Just a few weeks ago. And let's go to the stock market. Let's go to the Qs, right? Let's go to the QQQ and let's see where it was just a few weeks ago. April 7th, look at where it was, all down here. It had dropped a total of 23% from peak to trough. 23, actually, I mean, someone sold way down here, right? 25%. Let's just say a good 22, 23%. This is when everyone was feeling their worst. Everyone was feeling their worst about the market, right? Everyone's feeling their worst. But yet, when you look at how much it's gone up since then, it's gone up 24%. And it's not even at the peak. So just because people are feeling bad doesn't mean that things are going to go bad. Now, it also doesn't mean that people were feeling good, and all of a sudden people start feeling bad here. No, the feeling was getting a little bit worse and worse and worse. But again, the point is, you don't want to not invest just because people are feeling worse. You want to just keep investing. So the number three mistake is lack of diversification. Concentrating too much money in one stock, sector, or asset class increases risk. Diversification reduces volatility and protects your downside. And this is 100% true. I actually made the mistake a couple years ago by investing way too much into a stock. Had a lot of personal stuff going on, and I didn't diversify. I wasn't paying attention, the stock dropped, and I lost a lot of money and potential gains when I could have been buying other things. So you want to diversify. You've heard the expression, don't put all your eggs in one basket. And that is 100% true, because if the basket falls and all your eggs break, and then that's kind of what happened with me. I didn't put it all in there, but I did put a lot in there, and that really killed me. At a glance, portfolio diversification is a key long-term investment success. A well-diversified portfolio includes a mix of stocks, bonds, and potentially alternative investments across various sectors, company sizes, and geographic regions. The right asset allocation depends on your individual risk tolerance, time horizon, and financial goals. That's 100% true. You want to diversify. Now, really, if you can, right, if you have a lot of money, you can go stocks, you can go bonds, you can go cash, you can go real estate, you can do all kinds of crypto. There's all different kinds of things that you can buy. But if you have a limited financial balance or budget, you're probably going to be looking more into stocks. That's what, or crypto. And so, you want to diversify within that asset class, right? You don't want to just buy one stock. You want to buy multiple, 5, 10, depending on how much money you have. You don't want to over diversify either, though. You do not want to have 100 stocks and you only have $100. Like if you have Robinhood, or there's some other brokerages out there where you could buy $1 of a stock. You don't want to have $1 each of 100 stocks. You'd rather have $5 each of 20 stocks. That's how you'd rather. That's the better way of doing it. But you definitely want to diversify, because if one goes down, and that's what ETFs are for. If you have an ETF, which is kind of a way of diversifying in itself by just getting an ETF, because in that ETF, it has a lot of other stocks. So if one of those stocks goes down, the S&P 500, NASDAQ, if Apple just goes down, okay, that will drop. But that's, that is such a low risk probability. But if you get the other kind of lower companies and they start dropping off and stuff, it doesn't affect the whole ETF. So those are good ones to diversify. If you just want to kind of buy 1 or 2 stocks and just kind of not really mess around and learn too much, ETFs are a good way to diversify without having to do too much. So number 4, neglecting research. Investing based on tips, social media, or trends without understanding the business model, valuation, or fundamentals is risky. So a lot of people will hear about something, and obviously we have the GameStop, the AMCs, we have all that stuff, the meme stocks. When you just hear about something, hey, it did good, right? Do it. You should buy it. You should buy it. If there's nothing behind that, if there's no numbers or no just anything grounded with that, then why are you putting your money there? Even on Instagram, if I hear something like a funny story, not a funny story, but just an interesting article, this and that, or just a story that happened, I always want to go and do my research to confirm it's true, and so when someone tells you, oh, hey, it's a good stock to buy, you shouldn't just go and buy it. I think Celsius is a great stock to buy. I think you should buy it. I'm not telling you to buy it, but I think it's a stock that you should buy if you are looking to buy stocks. But why am I saying it? Now I could start breaking down all the numbers and everything, and now I'm starting to justify why. But if there's a lot of people just say Celsius is great, that's good. It dropped so much. It was at $80 and now it's at $35. It's going to go back up. You know it's going to go back. That's not what you want to hear. You want to hear that they had a Pepsi deal that affected their inventory, that went, it just affected their numbers. So their numbers look really bad, but now they're going to be comping against bad numbers. Their business is going to be going back into the growth that it was. And they are, if you go into a store, at least where I live in Los Angeles, Celsius is going off the shelves more than other ones, right? So I'm starting to give you reasons and justifications. Now that's just also me. You still would want to go and do your own research. Go check those stores, go check their earnings, go check all their financials, right? You want to go and do that yourself before you just jump in. Again, the last one, the last mistake, diversification. If you have an ETF, it's a little different. You're investing in 20, 50, 100, 500 stocks. So it's a little different. But you definitely want to do your research. You don't want to invest in the ETF and you don't know what's in that ETF. Number 5 mistake is over trading. Frequent buying and selling racks up fees, taxes, and emotional fatigue. Long-term compounding is disrupted. So if you're constantly trying to buy and sell and trying to be like, okay, yeah, I know this stock is going to go, down here. I kind of wish I had done that with Palantir. I sold a little bit early, and now, of course, it's gone up and it's higher than what I had sold at. And I'm not sure if it's going to go back there again. It did go back down in the last crash, but I don't think it's going to reach back down. I kind of wish, maybe if I had just held on a little bit longer. But I didn't really trade it. I bought it. I held on to it for about a year and a half or so. Bought it at 20, 18, 20, sold it for about 70. But I wish I had held it for a little bit longer. And, but if you're over trading, there's many times in that year and a half period where I thought about buying or selling and doing this, and I was getting a little bit exhausted of trying to pay attention of it in that way. So I kind of just sat back and was like, you know what, I'm just gonna invest. I'm just gonna invest what I have and let it ride, And then when it really shot up, I kind of took a little bit of profits, and then it kind of went up again, and then I did that, but I didn't try to buy, sell. It's exhausting. And if you're looking for the long term, again, you don't want to really be selling. You just want to be buying. If you buy, whether you were perfect timing or you were the worst timing, you weren't that far off. So you just want to just frequently buy. You don't want to constantly buy and sell. And depending on who your brokerage is, you might have fees with all that. Number 6, ignoring costs and taxes. Management fees, trading fees, and taxes can quietly erode your returns over time if not accounted for. I don't know if you've heard about this, but there's some of these brokerages where you have a 2% fee and all this and that, and over time it can really eat at your profits and your earnings, because a lot of them will also take 2% regardless of if you're making money. All right, they're still going to take money. So that's you have to think about that. Things have gotten a little bit better when you go into Robinhood and you go into all these other things, right? They have free trading and all this stuff. So it's a little bit easier now, but you still want to keep an eye on that just in case. Number 7 is a short-term focus. This channel and who I am, I'm way more long-term. I do understand the short-term outlook on hey, maybe now is a time to put a little bit more money into it, or maybe now is the time to kind of hold on a little bit more of cash, which is kind of what I did. I actually got more cash. I was holding on to more cash early this year, and it worked out well. But it doesn't mean that I am only thinking short term. I'm thinking, what can I do in this short term period? In this, next 3 to 6 months, what can I do to set my 3 to 6 years better, So it's, yes, some of the moves I have to make, I'm planning, they're short term, it's just more immediate, but it's not a short term goal, it's a long term goal. These are just not short term actions, but these are actions I have to take every week, every month in order to reach the goal that's going to happen in 3 to 6 years or whatever, right? So you just want to make sure you have that long-term focus, right? Because it says looking for quick profits often backfires. The stock market rewards long-term patience and discipline, and it really does. Let's check out this. Do I even have that? No. So let's just look long-term. I mean, let's go 5 years. This is the Qs. I got all these. Just hide everything. long term. This is since 2000 a little bit, and let's say you bought here at the very peak of the 2000s, the .com. Right now, obviously, yes, that was the worst time, but if you consistently bought, it would have been fine, right? You want to have a long-term goal. So if you just continue to buy, you say, hey, look, this is a time the market is shooting up so high, maybe now's the time I kind of hold on to a little bit more cash. And then when things start dropping, maybe I can start putting in a little bit more. But you're still buying throughout this time. You still made money. This is a long-term goal. Now, this is one of the biggest crashes ever for this NASDAQ, 100%, right? This thing crashed. Oops, I didn't do that. It crashed 81%, and it took 5,965 days to get back to where it was. It went from 2000 all the way to 2016. It took the NASDAQ to go from the .com bubble top, then to reach that level again. If you went all in March of 2000 and didn't invest another penny, you wouldn't have made any money until August of 2016. Obviously with dividends, maybe yes. But isn't that crazy to think, right? So you have to have a long-term goal. You don't want to just think all in right now and then I'm just going to let it ride. That was obviously one of the mistakes earlier. Have a long-term goal. Have the things that you're doing today are going to set yourself for longer, right? But don't be short-term at all. Failure to rebalance. Now, every once in a while, I rebalance my portfolio, right? I said I sold Palantir when I wish I kind of hadn't at that time, but I did. It's because I was rebalancing my portfolio. I said, look, the valuation has gotten a little heavy. I think I'm going to take some of the profits and take back some of this and invest into some other stocks that I think are going to do a little bit better. Now, somewhat of a mistake because I would have, had a little bit more in the Palantir and I would have gained a little bit more, but I also had the opportunity to buy some other stocks that I'm happy I bought. So I want to rebalance. Now, again, like the other one was over trading, right? Number 5, you don't want to over trade. You don't want to over rebalance either. You want to make sure you're balancing. You look at it every month, looking at it good. But when you want to talk about a heavy rebalance, you should only do it twice a year, maybe 3 times a year. You should really be looking just more to add to your portfolio, right? Or if there's something that really happens bad in a company and you're like, light went out, something really bad happens, then it's like, okay, I could step away from the stock. Okay, you do that. But to constantly rebalance, do it. You don't want to do that. But you also want to rebalance. You have to adjust your portfolio to the goals and risk tolerance, and you don't want to leave yourself overexposed or underperforming, which is what I did. I failed to rebalance in 2021, and that hurt me so bad. So always rebalance. Not always, just keep an eye on portfolio, rebalance a few times in a year. Overconfidence. Believing, that's number 9. Believing you can beat the market without the data or discipline, support beliefs. That kind of goes with the other earlier mistakes, right? When they were saying, just doing it because of, you heard something, just timing the market. All these things, it doesn't work. Don't have it's not a game. No one's here to win. No one will win and no one will lose. The only person that is going to win or lose, there's only one person in the game that can win or lose, and that's you, right? If I invest all my money and I make $1 billion, you know who else wins? You say your family, right? Yeah, I get that. But me, not all the other investors, no one else is going to win, I win. And if I lose all my money, I lose. So don't be overconfident. It's not a game. Just be focused. Be chill, buy the dip, and don't trip. That's what I say. Not having a plan. Investing without a clear strategy, goals, timelines, and risk tolerance often leads to reactive decisions and poor outcomes. Now, you want to have a plan. Make sure you have a plan. Say, hey, I want to buy this stock because I have this goal. I think it's going to do this and this and that. And over the amount of time, over years, hey, I'm going to invest X amount per month because you have some plan. If you're just going in whatever, it's not going to go well. You have to have some kind of plan, some strategy. Consistency is huge. Consistency. That was the 10 mistakes. Now I'm going to give one extra credit one for the 11th. And it's some that I had actually messed around with as well. I made mistakes. It cost me dearly. And I think it will cost a lot of other people too. We're not at all-time highs with it, but it is something that a lot of newer people will start messing with. And it's margin. If you trade on margin, it's dangerous. It's essentially trading on a credit card, right? But here's the difference. Let's say you buy $1,000 of stocks of your money, right? So you have $1,000, but then you also bought $1,000 on margin, okay? So now you have $1,000 of your own and $1,000 of margin, so you have $2,000 worth of stocks. Now, let's say the stocks get cut in half, right? So now you have $1,000 worth of stocks, right? Guess how much you owe them. Do you think you owe them 500 because it went in half, right? It got cut in half, right? 500. No, you owe them 1,000. You owe them 1,000. So if your stock, you bought $2,000 worth and it got cut in half and you're at $1,000, you owe the brokerage $1,000. You've lost all your money. Right? So by a stock going down 50%, you could lose 100% of your money. So margin is dangerous. It is a dangerous game, and that is gambling. It is gambling, and I messed with that. And I did a few of these mistakes. I didn't have the right research. I neglected it. I was going through my own personal stuff. I fell down a cliff end of 2019 off a 100-foot cliff, and I was just dealing with so many things along with the COVID and the rehab. There was just so many things I wasn't focused. I wasn't in the right mindset. And I did trade on margin for a little bit. And when I got a margin call, that was a huge eye opener. You know, I was like, wow, that I'm seeing what I just did. I lost value in stocks, and I can't just, I just lost money. I just lost money. And it's different. Like usually when you lose stock, you can kind of like hold on to it. It's just totally different. So margin is something you got to be careful. Don't mess with it. Do not mess with it. I have a margin account so that I can, the access and the transactions happen faster, right? I can liquefy my account as I can get my cash quicker. I can get cash in there quick. All those things happen. I also mess around with options. Maybe that's number 12 too. Don't mess with options. Options are dangerous, and people have watched The Big Short and they think they can short this and short that, right? You got GameStop and all. Be careful with options as well. But I do have options. I have pretty secure, they're safe options. They're all in the profits, and they're very low. Those are my hedges. So I kind of like, I don't put too much in it. I don't not put too much in it. But in order to have options, in order to have these transactions go a little bit faster, my account is a margin account. But I'm not using margin. I have access to the money. They're totally willing to say, hey, here's some money. And also you have to understand that you pay an interest. So you don't just, on margin, when you buy the $1,000 of stock, right? And you have your thousands and it went down 50%, now you also owe interest on that money. So it is huge to just avoid margin. If you do not know what you're doing, just in general, why mess with margin? So I think that's probably one of the top ones, because I think a lot of people do it. I think a lot of people in the beginning do it. I did it because I was having, I was overconfident about some things, and I was having, and at a time I was performing very well. And I put too much margin, and I didn't understand exactly how impactful it was going to be to my portfolio at the time. And now I know, so don't make that same mistake. Do not make the same mistakes I made. And don't make any of these mistakes that are on this list. So again, thank you for watching. Please give a like and subscribe. It really helps with the channel. I hope you liked all this information. I tried to make it really quick. It's about 30 minutes or so, but try to get through it really quick for you. And again, this channel is all about long-term investing. I'm trying to do what I can. I've made my mistakes. I'm no millionaire crazy, but I hope throughout my journey on YouTube, maybe I can become a millionaire. I mean, you can see me go from what I am today. I got a 5-figure portfolio right now to, a 7-figure portfolio. That'd be really nice. So But what I have to do is try to avoid making any of these mistakes, and the same with you. So thank you for watching. And again, give a like and subscribe if you liked it. And don't forget to
earn it, save it, invest it, buy low, sell high. I want assets, not liabilities, and you can count on compounded interest.